Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, welcome to the latest edition of the ASB Investment Podcast. We're back for 2025. It's the first show of the year. We've had the summer off. Well, we've had the summer off the podcast. The hair's a bit longer. Mine is. CTB's not. The summer glow is in full effect. The flowers are in bloom. So it's. I could not describe a more appropriate backdrop for a podcast about financial markets. It's just asking for it. As always, I'm your host Nigel Grant, back for another year. And in this first episode for 2025, we're gonna dig into what's been happening in global markets and New Zealand, and what could happen as we head into the year ahead. Probably also mid-February as well, in particular, because there's a lot happening, to say the least. Today I have someone who'll be familiar to many people. We've managed to remove him from his airplane circling Auckland and his flying escapades. It's ASB's senior economist, Captain Chris Tennent-Brown. Welcome back, CTB. How was your summer break?
Oh, it's been pretty good. I enjoyed a bit of the tennis, which was fantastic. And the garden's looking great.
Is it?
Yeah. I've managed to keep all the lawn growing. I've had builders renovating last year, and so a big clean-up operation for me. Getting the gardens looking nice again, and we've been enjoying that.
And you said at the tennis, because we hosted an event, me and CTB were both on it just for our clients down at the tennis this year, but you told us that you were up circling the skies, right?
Yeah, I've been doing a bit of flying as well.
Yes, and where and in what plane?
So the one I've been flying lately is called a de Havilland Chipmunk. And
okay.
Some people call it the poor man's Spitfire. It basically looks like something that Tintin would fly around in. It's a two-seater, but you sit one behind the other.
Yes.
Like a fighter plane.
Like Top Gun. So it's effectively Top Gun.
That's right, except we're doing about 90 knots rather than 900 knots. So there's no sound barriers getting broken in the Chipmunk, but it's a neat old plane, and that's been a bit of a thing for me to take a New Year's Day flight.
Yeah.
And
did you do anything for Auckland anniversary?
No, one thing I've done lately, not flying, is I went tramping. I took took the long
So from the sky to the ground.
Yep, and my knees are still sore.
What'd you tramp?
I did the Humpridge track, which is down the bottom of the South Island.
Is it? Okay. How long's that?
60 kilometres over 3 days.
60?
Yeah, that's right. And there's a million steps. If you don't like steps, don't do that tramp.
Did you know it was going to be as it was when you signed up for it?
Yeah. I'd done the Milford track, and that's got a pretty massive hill in it, but this was harder than that.
Oh, okay.
So I was glad I watched how much I ate over Christmas, because the lighter you are, the better you're going to get up those stairs.
Right. Well, hopefully you can still, get up on the plane as well. So let's start. Welcome back to the studio, first and foremost. So let's start with the big picture view of financial markets. Over the last 3 months since we last recorded, we've seen quite a bit of action, to state the least. Locally, internationally, there's been a rather big thing that's happened in the States. What have you been observing, and what's noteworthy for investors to take away?
There's a few things, and I always think about what's going on in share markets, what's going on for interest rate markets, and when I'm thinking about our customers, there's two sides to that interest rate story. One is what rate are people borrowing at, and clearly the lower the better. There's people trying to go, what's my strategy to minimise my mortgage costs? On the other side of the equation, there's our customers that on the saving side of it that are going, hey, what happened to those 6% term deposits? What do I do with my money?
Yeah, which is the less talked about side, isn't it?
Yeah, that's right. But there'll be plenty of people thinking that they were much happier in the term deposit space a year ago with the higher rates than they get now. And then in the mix, we've also got what's going on with inflation, which clearly impacts your overall returns. But for the share market, last year was a great year for share markets. They went up a lot. Our market underperformed
in the first half,
global markets. But certainly went pretty well. And share markets in early 2025 have been choppy, but they're still knocking around all-time highs or within a few percent of all-time highs, despite the fact that we're getting some big headlines coming out from you-know-who.
Yes, certainly are.
This year's reports will be brought to you by the letter T.
Yes, and what does that stand for?
T, or tariffs, Trump, term deposits. But Trump's obviously the one that we're all talking about and causing a bit of volatility. So those, to sum it up, I've been watching those developments with interest rates, seeing what customers are doing, and what strategies they're running, and of course keeping an eye on the global politics and the inevitable volatility that comes at times like this when there's a bit of uncertainty.
So we're recording this in and around the time that new tariffs were announced on certain countries from the States, and we've seen markets whipsaw around even just in the space of 24 hours. I guess, in line with the year is going to be brought to you by the letter T, do you have a view on, or does the House have a view on these tariffs?
I think it'd be pretty hard to get through an economics degree and think that tariffs were a good thing.
Right.
And so no surprise that for a country like New Zealand that is really, really dependent on global trade, things that get in the way of trade, like protectionism, the inward focus that the States has got at the moment, and tariffs, part of that. It's not great news.
No.
I don't think it's a great strategy. I'm sure that anyone in the economics team would agree that the world's a better place with more trade, and tariffs means that no one wins. Consumers pay higher prices, there's less trade. Yeah, that's the view, but that's also what we've got. Markets are bouncing around all over the place at the moment in response to this. But gee, it's no surprise. Trump campaigned on this stuff.
Yeah.
It's the unpredictable nature of how he executes strategy that is what's a surprise. Okay, is it going to be 25%? He talked about 60% tariffs on China, but that's not what's happening at the moment. And then not only should we date stamp our reports, we need to have them down to the minute to say, at 7:45 this morning, this is what's happening. Because it's 7:57, it could change.
Yeah.
And not because there's an amazing development. It'll be something appears in social media.
Tweet, an announcement.
Yeah. In turn, none of the stuff's surprising because it's what Trump campaigned on. He's doing what he said he was going to do, but it just changes so quickly. Markets don't like uncertainty, and so what does that mean? You just get volatility, but in both directions. Markets lift off their lows when there's good news that gets tweeted out or whatever is the format, on
swings both ways. So
that's right, but that's what we're going to have for the next few years. It doesn't mean it's going to be a bad time. But there'll be some headlines, and we'll all just have to focus on the long term and see our way through some ups and downs.
Play the hand you've got. Play the hand you're dealt. Sorry. So looking at, I guess, closer to home, looking ahead, there's probably a big question that's on everyone's minds, or a lot of people's minds, particularly if you're a homeowner or that term deposit saver. So in a few days, the RBNZ will announce its next OCR decision. What's your or the ASB House view on what might happen, and what's driving that view?
Ultimately, inflation's coming down. I always think the Reserve Bank's got two jobs. One is financial stability, so that's things like regulating the banks, the rules that we operate within. But the key job they have is price stability.
Yes.
Inflation, targeting inflation, keeping it around that 2% level, which is what it's got down to. So in terms of what this means for interest rates, interest rates are the tool that they use to try and influence inflation with the economy. As inflation pressures have come down, the economy's slowed down a lot, the Reserve Bank needs to keep moving from restrictive interest rate settings, thinking of 6-7% mortgages and a 5.5% official cash rate that went hand in hand with that. They need to get it down to what we'd call a neutral level for the official cash rate. So this is somewhere between 3 and 3.5% below where it is now.
So we're still restrictive.
So that's why we think 50 basis point cut is how they should start the year.
That's the house view.
Yep. And from there on in, once we're down into that 3 to 4% range, which would be in, it's about, well, how much more do you want to lower the official cash rate? And we still think that they'll get down below 3.5% over the first half of this year.
And then let it sit.
Yeah, but the important thing for people that are in the term deposit or the mortgage space, that's priced into the market. We're not forecasting something weird. Financial markets are priced along the lines of what I'm talking about. So if you look at a 2-year mortgage now, it's come down an awful lot compared to its peak level. So it's gone from close to 7% now to below 5.5%. So it's fallen in anticipation of what the official cash rate's going to be and what interest rates within the economy are going to be over the next two years.
You said yesterday we were on another call just with our staff, and you mentioned something really important. I said we need to talk about it, which is really helpful. You said the OCR, and not in these words, but to the effect, is not a direct contributor or lead to home and TD rates.
Yeah.
And so like I guess you see the 6 o'clock news on the day, they talk about it. Why does that not influence it directly, or what is?
Yeah. I think one of the things which is really unfortunate language people talk about is, are you going to pass on this official cash rate cut to your customers? But the reality is, we don't fund the bank at the official cash rate. We don't go to the Reserve Bank and borrow lots of money off them and then turn it into mortgages.
Yeah.
We effectively borrow money off our term deposit investors.
Yeah.
And
or internationally.
Or internationally, or in wholesale markets when we issue bonds, and then we lend that money out. But the official cash rate influences some of those costs, particularly the short-term funding costs. So I think it's really worth remembering that, hey, when we're recording this a week or two ahead of the RBNZ meeting, we trimmed our mortgage rates this week.
Yes.
And so it's worth remembering that when on the Reserve Bank's cash rate announcement, if they do what we think they're going to do, we won't necessarily go, right, let's trim our mortgages. We need to change them. We've done that already in anticipation. And a good example is if you look at how much a 2-year mortgage has fallen by, a 1-year mortgage has fallen by, they started moving well before the Reserve Bank started cutting the cash rate. And so getting out of that habit of thinking that it all revolves around what the Reserve Bank does on a day and that should immediately trigger off some interest rate adjustments I think it's a good thing. And likewise, people need to plan their strategies not based around what the Reserve Bank does on a particular day and thinking that a couple of days after that will be a good time to choose a new strategy. People should be talking and thinking about what they do with their mortgages, their term deposits, their investments all the time.
Okay. So we were talking earlier around not trying to bottom pick, whether that's the right term.
Yeah, no one.
I'll invert it. Pick the bottom
is
probably more appropriate. So I was saying to you, I guess if you're waiting, were you able to pick the bottom or on top of things before? And if not, should people be looking at things now and not, advice notwithstanding, what a bird in the hand is better than two somewhere else?
Oh, yeah. And with the mortgage rate strategy or a term deposit strategy, it's about, for mortgages, minimizing the interest you pay over the life of a mortgage. And for many people, it's going to take them 20 years to pay off that mortgage. It's not about going, wow, I got the all-time low.
Yes.
But gee, I had to float for 6 months while I was waiting for it and paid a pretty price for that.
Yeah.
So a better strategy than floating for the last year would have been to have fixed a year ago.
Or even in different tranches, or just break it up.
Split your tranches up and that sort of stuff. So it's a change of mindset to think about just lowering your interest costs, making sure you've got flexibility for repaying a loan, rather than going, I locked my mortgage in at the ding dong low.
Yes.
But I paid 7% plus to float to get there.
It's almost a bit of like cut off your nose to spite your face.
Yeah, and it is hard. People struggle to work out that sort of stuff, but that's why we write things like our home loan report and try and point the risks of and the pros and cons of each strategy, I guess. And if you talk to a term deposit investor, it's the flip side of the same conversation.
Yep.
People probably are kicking themselves now to go, oh, why didn't I lock in a 5-year term deposit 2 years ago when they were so much higher? But at the time, they didn't think rates are going to fall this much.
No, or you might get another 10 basis points.
Yeah, and so what does it all come back down to? With a lot of these things, we're talking about long-term strategies, and so getting bogged down in the Reserve Bank meets next week and they're going to do this and do that. Well, think about the long term on both sides, term deposits and mortgages.
You said to our clients at the tenor side, which I like, was with regard to property purchasing, but I think it's appropriate here. It's kind of like the best strategy is just often to just do something today.
Oh, get on with it, and a lot of people are asking us what we think is going to happen with the property market this year, and do we think it's going to go up 5% or 10%, or someone else said this and said that. To me, it's my punchline is get on with it. If you're in the business of buying a house and borrowing money, get out there, do your research, know your budget, know what the market's doing, and you're not going to do that sitting at home. You've got to get out and do your research. And again, I always try and just get back to the longer term focus on these things.
Yes, yeah. Don't sit. I guess if you've got something you want to do, just do it rather than try and pick the perfect time. So let's shift gears a little bit and talk about things that can influence kind of rates as well as the OCR. We've talked a little bit about it already, but there's a few major things happening around the world that investors should be aware of. What are the top geopolitical areas or firestorms that you're keeping an eye on this year, and how might those impact investors?
I think the geopolitical uncertainty, and if we think about conflict in the Middle East and in Ukraine, is always going to be alarming, disturbing, and something we read about. So I get used to just thinking there's going to be some background bad stuff going on in markets, and
markets climb a wall of worry.
Yeah, and the big thing I think for I was going to say the year ahead, but really it's the next 4 years, is it's going to be unpredictable, just like we saw in Trump's first 4 years. Yeah. It's just the way it goes, if you like. Markets will respond to the environment that they're operating in, and the environment can be pretty positive over the year ahead. It's definitely going to be one where interest rates are lower than what they were a couple of years ago, when central banks all around the world were really battling with inflation. An uncertainty, and something I'll definitely be watching, is what are the inflationary consequences of some of Trump's policies? Tariffs in particular, I think, will lead to higher prices for consumers in the States, which in turn, if you've got a bit more inflation, will the Fed
doesn't have to cut as much.
Will be less inclined to want to stimulate the economy by cutting rates so low. So that'll be something that the markets grapple with over the particularly over the months ahead. But potentially over the years ahead as well, as we just keep getting unorthodox economic policies coming out of the White House.
Yeah, notwithstanding, the when certain conflicts or things, and the abhorrent things that are going on in them, and some of those uncertainty around policies, that some of that stuff is really hard to deal with. But you shouldn't let that potentially, change a long-term plan that you already have in place. Yeah,
that's right, and this is, I think, particularly with the geopolitical uncertainty, which is hard to watch and really disturbing. It's worth thinking, okay, well, what's happened in my case over the 30 years I've been investing? Gulf War I, Gulf War II.
You name it.
Yep. There's just been heaps. In financial markets, there's been the Asian crisis. There's been the global financial crisis. There's bad stuff that happens every few years. But you can't just stop and start your investment strategy around bad news headlines. Yeah. You've got to have a long-term strategy. And to a certain extent, be pretty galvanised against some of this bad news. It's not game changers for the way we invest, even though it's pretty alarming to watch some of the stuff that's going on in the world.
And so closer to home, I guess we've had government bit of a reshuffle to start the year, and that, I guess, the cabinet reshuffle as such. Mr. Luxon has made some key changes with the hope of revitalising, I guess, the government's focus. In January, we heard the message around, it's all about growth, or, supercharging. That's the focus for the year. Is there going to be an impact of what they've done? Will it make any impact on economic growth?
I think that the bits that are frustrating with the New Zealand economy for many people are, I think, an underinvestment in infrastructure.
Yes.
And
innovation.
And poor productivity growth.
Yeah.
Now, this isn't something new that we've just discovered. This is something that we've been talking about for decades. Increasing productivity increases the ability to pay higher wages, increases the chances of a more prosperous outlook for everyone.
And what do you mean? So just quickly, what do you mean by productivity? Is that basically what we produce for the hours worked?
Yeah.
All right.
Basically.
Okay.
And so that ties in with investment,
R&D
from both the government side of things, providing the infrastructure that can support the economy, and investment from us. Having strong capital markets where firms can raise money to buy plant and machinery and all of that sort of stuff. And so these aren't new problems that the government has to tackle. They're always there as problems. And for the last government, clearly dealing with COVID was a
handbrake,
a massive thing. And we could talk about that for hours, about the pros and cons of various strategies that the government could have taken. But right here, right now, we're back to a more normal environment where hopefully we don't have any disasters to deal with, and hopefully the government and future governments can just try and do whatever they can to make New Zealanders a bit more productive, which I think is all about saving, having the right infrastructure projects going on, and
incentives to invest. Maybe.
Yeah, and I personally, I just wish we'd see a bit more long-term planning. It seems like a new government, but we'll be halfway through the term pretty soon. And
then it gets into electioneering year, doesn't it?
And get into electioneering year. So things turn around pretty quick. And so this year will be a big one for rolling out, hopefully, policies, ideas to address some of these issues. But I don't think there's no magic bullet. And one of the words I use when we talk about the recovery from a pretty tough couple of years is I think it's like a grinding recovery, because there's no silver bullet that you can just go, let's just do this and the economy is going to be growing strongly again.
Yeah.
They're really hard challenges for us, and it's been a difficult period that we've come out of. But
and I guess for a government as well, like you unfortunately, whether that's the right word, you're probably planting seeds that you may not be in power to see reaped.
Oh, exactly, and impacts the thinking. A classic is people talk about, will we ever have a capital gains tax in New Zealand? If you did that, it's political suicide. You're going to be out at the next cycle, and it'll take a decade to pay back a policy change like that. So it's probably never going to happen in the next 2 or 3 election cycles. And some of the infrastructure spending that needs to take place, we've seen it over the past 6 years. We'll flip-flop backwards and forwards on policies. In Auckland's case, the light rail to the airport, yes, no, it's a no at the moment.
Yeah.
The East-West link, both big infrastructure projects that you're not going to build it in 3 years, but they can get cancelled pretty quickly. I saw,
and this is not an advocacy position or a positive. It's purely neutral on mining. But I saw, with that recent announcements on we're trying to introduce a bit more mining back in the production from it. I think one question was raised to another commentator, which was, is this going to see more come in? And the person was kind of like, well, if you're a big leader or chair or CEO of a big mining company, are you looking at New Zealand because you don't have a certain environment? Are you going to invest more when you don't know in 3 years' time if that policy is going to be flip-flopped?
Yeah, I mean, investors, be it a global firm looking at a project or a mums and dads, people like you and me with KiwiSaver, don't like uncertainty. And so the more certainty you can provide, regardless of the policy, the better. And so that's where I think, firstly, the more long-term planning for some of the big issues for New Zealand, savings, investment, infrastructure, The more longer term we can think about that, the better. But in the here and now, 2025, I think, well, none of this stuff, there's no light switch that's going to get flicked on, regardless of how you shuffle people doing particular roles. And so the base is this grinding recovery for the economy. A thing which is tricky for people to think about is normally when we're talking about an economic slump like we've been through, we expect the Reserve Bank to come to the rescue and the government to come to the rescue by stimulating with spending. But that's not happening right now deliberately because of the inflation that we've been through and the desire to get the government's books looking better after COVID. So it all feeds into a grind rather than a boom bust that's going to suddenly get stimulated and create another boom.
Hopefully more sustainable, acceleration out the other side. Let's finish off with a 3-letter acronym, is it, or word, I guess, CPI. So you mentioned it before, how do you interpret the latest data? What implications do you see for how that flows through to what the RBNZ is looking at for February and onwards?
Well, at a very basic level, the Reserve Bank wants inflation, and they look at the Consumer Price Index as their measure of inflation. They want it to be averaging around 2% over the long term,
which we're close to.
Yeah. And so things like tariffs, what's happening in the labour market, what's happening with wage growth, all are really important for that. And the Reserve Bank will be taking that long-term approach. So we think that the inflation genie is back in the bottle.
It's back in there.
And that's why we think the Reserve Bank can keep cutting the official cash rate down to a normal level. Various commentators differ in their opinions as thinking, well, do they actually need to stimulate the economy by getting rates even lower? And we don't think they will. We think, if they get the cash rate down to around 3%, mortgages are in that 5 to 6% range. Term deposits 3.5 to 4.5%. That's sort of neutral settings for the economy and in the equilibrium. Of course, we never stay in equilibrium for 10 years.
No.
In a year's time, they'll be responding to whether the economy needs more stimulus or less.
But I guess that allows them then to tilt to the other side if they need to.
Yeah. And I think that an important thing that we've discussed a little bit earlier on is something like a 2-year mortgage is really pricing exactly what we're forecasting, and right now. So we're not thinking that the economy's so bad that we're going to see 3% mortgages again like we saw in the pandemic. Those were really emergency settings. And so a little bit like getting out there and looking at houses when you're trying to buy one. You might not buy it tomorrow, but an awareness of what's going on in the overall market's important. It's the same for savers on the term deposits, borrowers with mortgages, is getting a feel for what people are saying to try and get an idea of what's normal. And I think something like a 2-year mortgage right now is pretty close to normal in my books, and I don't expect it to fall a lot below where it is today, and I don't expect it to lift a lot over 2025.
So to wrap up, would that be your key takeaway punchline?
What, to do your homework?
Yeah,
study what's going on.
Like what's in the hand now is look at your circumstances.
Yeah, I think people need to not be waiting for things to get back to where they were in during the pandemic. Those were really unusual times for interest rates. I also think it was a really unusual time for interest rates when we were doing that scrap with inflation.
Yes.
And so working out what's normal, which I think is rates not too far away from where they are today, is something that people should work out how they can operate in that environment rather than waiting for rates to get much higher for term deposit investors or for them to get much lower for borrowers.
And so we've covered a lot of ground, as we always do. We just go on for hours, me and you, but there's one last question we want to get to now, my favourite question. What's something you're currently reading, watching or listening to, or in your case doing, that you'd recommend to investors and listeners?
Oh, well, my thing at the moment is...
Here we go.
I think we talked about this in earlier podcasts. I'm just totally into going out to watching live music. The after being locked up at home, I just got so excited starting to go to concerts and things like that again.
Yes.
So I'm going to do a relive my youth and go and try and take in a few old bands. Shiard's one I'm looking forward to.
Fabulous.
I like going to any tribute band that's going to belt out some cool tunes.
Did you go to anything over the summer break?
Yeah, I went to an ELO tribute band concert, which was pretty cool.
Right, Electric Light Orchestra?
That's it. Okay. And Jeepers Creepers, that was pretty good.
Yep.
And a couple of other ones, but Shiard is the real deal. I'm going to actually see, the original band in a month or so.
I'm not sure. I'm not sure how many senior economists will be at Shiard, but I stand corrected if it's a popular vocation.
It's funny to think. Well, these are in some cases like this, people I saw at university. So the people that are on the stage have probably got the same problems I have with grey hair falling out, although they probably do a better job of looking a bit younger than I am.
The only thing that I was going to say was because it's been sort of topical, would be if you're wanting a little bit more on all things AI, the DeepSeek news that hit world markets the other week, we were talking about it overnight that Monday and Tuesday. I know CTB, I think, we were on work calls a little bit talking about it and educating our teams about it. I might have mentioned in the past, one of my favourite writers is JP Morgan's Michael Sembelis, but he did a technical rundown on it if anyone wants to go really deep on it. So we're talking multi-token predictions, power consumption, and Jurven's paradox, which I learnt about only the other week, which I'll leave it to listeners to go and Wikipedia that. If it's good enough for the Microsoft CEO to be tweeting Wikipedia links, it's good enough for you. So there we have it. We're at the end. CTB again, as always, thanks so much for joining us. When are Aucklanders going to be able to see you up in the sky again?
I'll be flying around this weekend, hopefully.
Oh, Waitangi weekend.
Yep. Okay. So if you hear a drone of a Harvard, it could be me, or if it's a bit more of a buzz, it could be being the chipmunk.
Okay.
And meanwhile, if it's raining, I'll be going to my favourite reading post. Carrying on from your theme, The Economist is still what I like to do to get to the bottom of some of these issues.
You can't read The Economist while you're flying, can you?
No, I don't.
Okay, all right.
No texting while flying, no reading The Economist.
Okay, just on the check. If you see him up there, you know he's not reading. Until next time, thanks again, CTV, but until next time, happy investing and bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.